Welcome to this explainer. Today, we're diving into a total head-scratcher of a situation, the Q2 2026 earnings report from AI chipmaker Cerebras Systems. It's this wild story of record-shattering numbers, massive investments, and a market reaction that literally left everyone asking, wait, what just happened?
All right, let's kick things off with the ultimate headline number, 103%. Cerebras just reported a staggering 103% year-over-year growth in core revenue. I mean, they utterly crushed expectations, pulling in a record $209.9 million. This wasn't just a tiny beat. This is the kind of massive top-line explosion that usually sends a stock straight into orbit, especially since they also significantly improved their core operating margins from a year ago.
But, here is exactly where the plot thickens. With that kind of massive top-line success, strong operational leverage, and even raised guidance for the rest of the year, we've got to ask the billion-dollar question. Why on earth did Wall Street react with a brutal 16% after-hours sell-off? How does a company literally double its core revenue and instantly lose almost a fifth of its value?
Well, here's our roadmap to solve this little earnings mystery. First, we'll look at the record-breaking core numbers. Second, why the stock plunged. Third, the strategic bull case. And fourth, margins and the future.
Starting with Section 1, record-breaking core numbers, and where all that massive growth actually came from.
So, when we actually peek under the hood of that $209.9 million in core revenue, a really clear narrative jumps out at you. Core cloud and services skyrocketed by 287%, hitting nearly $128 million. That completely dwarfs the 17% growth we saw in core hardware. Now, to be fair, the hardware side was held back a little bit by what management called lumpy delivery schedules. Basically, some clients just didn't have their data center capacity ready to plug in Cerebras' massive wafer-scale chips yet.
And driven by these massive OpenAI deployments and just this insatiable demand for lightning-fast inference, the cloud side of the business has totally taken over. It now makes up a dominant 61% of their total revenue pie. Just 1 quarter ago, that was only 43%. So what this proves is a rapid structural shift in how customers want to use Cerebras' tech. They want the raw power, but they increasingly want it handed to them as a seamless cloud service.
Moving to Section 2, why the stock plunged, and decoding Wall Street's panic. All right, so what actually terrified the investors? Well, while core revenue hit that beautiful $209 million mark, standard GAAP revenue came in at just about $180 million, missing analyst expectations. Honestly, the market suffered from some serious tunnel vision here. Wall Street's algorithms got completely hung up on that GAAP miss, which, by the way, was totally distorted by a massive $386 million non-cash stock-based compensation charge. We're talking paper expenses for employee stock here, not actual cash walking out the door. But that flashy headline completely masked the real operational strength underneath.
But okay, to be fair, it wasn't just an accounting quirk that spooked the market. The second big red flag for investors was a noticeable dip in core gross margins, dropping from 46.5% down to 40.6% sequentially. Management actually chalked this up to a highly unusual but honestly kind of fascinating strategy. They actually had to start renting back their own systems from their cloud customers. They literally had so much demand for their fast inference cloud services that they ran out of their own internal capacity.
CFO Bob Coleman hit this head on. He pointed out that if they hadn't taken on those higher costs to expand their private cloud, by renting back those systems, their core gross margins would have been roughly 500 basis points, or 5% higher. So, translation, this margin hit was really just a temporary growing pain. They basically chose to take a hit on margins today so they could serve this overwhelming customer demand while their own much more cost-effective data centers are still being built. It's totally a self-inflicted cost of growth.
Which brings us to Section 3, the strategic bull case, momentum, cash, and partnerships.
So management is out there aggressively defending their long-term position against all this short-term panic, and they've got some heavy ammunition. First up, they are sitting on a gargantuan $8.6 billion cash pile, giving them ultimate flexibility to invest way ahead of demand. Second, they actually raised their full-year core revenue guidance to between $880 and $890 million. Third, they're opening up a major hyperscaler channel with AWS Bedrock launching in Q1 of 2027, literally putting Cerebras directly inside Amazon's data centers. And finally, there's this game-changing AMD partnership for what they call disaggregated inference. By letting AMD's racks handle the parallel processing and Cerebras handle the sequential processing, they can multiply token throughput by up to 5 times. It's wild. But honestly,
The most bulletproof defense management has is this staggering number, a $25.4 billion backlog in remaining performance obligations. This right here is the ultimate proof of concept. It guarantees multi-year revenue visibility. It proves that no matter what kind of quarterly bumps happen with hardware delivery, customers are eagerly locking in this technology for the long haul.
And why are they locking it in? Well, CEO Andrew Feldman summed up their whole strategic vision perfectly. He said, "There is no slow search because nobody wants it. There's no more dial-up because nobody wants it." The argument is super simple. In the AI space, the entire inference market is eventually going to belong to the fastest hardware. Fast inference wins. End of story. Because absolutely nobody wants a slow AI assistant. And Cerebras is positioning itself to be the undisputed king of speed.
Let's wrap things up with Section 4, Margins and the Future, and the Roadmap to Recovery.
To their credit, management is being incredibly transparent about the near-term pain they're facing. They are plotting out a pretty rough third quarter, projecting margins to hit a trough of around 38 to 40%. But they're also predicting a very sharp recovery in quarter 4. Why? Because that's exactly when those newly built owned data centers finally come online, meaning they can stop renting all that expensive capacity from their own customers. Ultimately, their long-term target is to push those gross margins up to 60% or more as the company really starts to scale.
And their confidence in hitting those massive future margins, it isn't just wishful thinking. It's grounded in some pretty hardcore structural advantages. First, they've got a planned 20-fold throughput upgrade rolling out over the next 18 months. Second, they're leaning hard into a highly efficient 5-nanometer process node, which keeps them a step ahead of competitors who are still pulling their hair out over trickier 3- and 2-nanometer yields. Third, and this is a huge one for saving cash, they have zero dependency on expensive supply-constrained high-bandwidth memory, or HBM. And finally, because they deliver answers faster than literally anyone else out there, they can just command premium market pricing for those super-fast tokens. Which brings us to our final thought for this explainer. When you step back and look at that massive $25 billion backlog, the explosive cloud growth, and management's crystal-clear explanation for why margins took a temporary hit just to capture more market share, you really have to wonder, was this 16% stock drop just a drastic, algorithms-gone-wild overreaction? Or is it a rare, golden opportunity for investors who are willing to look past the immediate noise of stock-based comp and rented servers? The next 2 quarters of execution are going to be absolutely critical to watch. Thanks for joining us for this explainer, and definitely keep your eyes on how they manage this incredible scale.